we straight away dive into today's session. May I request Ketan to kindly put the presentation. Thank you so much, members from ICI, respected members from ICI, for your time, and other respected professionals who have joined us for this presentation today. As Dr. Sambit said, so far as today's topic is concerned, we shall be dealing with incentives and benefits which are available to MSMEs, whether they are into exportation of goods or exportation of services. So what are the various benefits from a foreign trade policy and other custom benefits? We shall do a deep dive into that. Yeah. Let's first of all see the contents that we will be covering today. So we'll of course begin with a background as to why these export incentives are offered by the government of India. What exactly is the $5 trillion dream that the government of India has? How all of us businesses have grappled with the impact of COVID and how we are on the path of recovery thereafter. We will do a deep dive into various FTP benefits which are available to MSMEs and startups as well who are into exportation of goods and services. So these namely are RoadTap, which is remission of duties and taxes on exported products, duty drawback, SCIS, that stands for Services Export from India Scheme, EPCG, that is Export Promotion Capital Goods Scheme, Advance Authorization, and we will also be doing a deep dive into FTA, PTA, what exactly are they and how they can really, help the importers while they are importing significant raw material into the country. So let's, first of all, understand the very basics of export incentives. Why you are getting export incentives as exporters? Number one, you are earning foreign exchange for the country. For any economy, as we know, foreign reserves are very, very critical. Number two, we are generating employment, at a large level, which is very, very critical, again, for the economy. And number three, we are giving a push to the Make in India flagship program that the government of India has. Once we do export, we are giving impetus to the Make in India as well. Yeah. From a special focus on MSME is concerned, let's put the numbers on record. Around 40% of the total export that happens in India comes within the category of MSME. With the advancement of technology, increased adoption of e-commerce and digital platforms, this has of course led to seamless cross-border transactions as the payment channels have become very, very easy. And also, keeping into perspective MSME, the importance thereof, recently the government of India has also expanded the definition of MSME to say that, any turnover, any organization having turnover up to 250 crores along with some other conditions shall be considered as MSME. While, this definition was revamped, exportations were excluded from the ambit of this particular number. So government, of course, knows and believes that MSME is a very, very strong sector. And in as much as, it is a great contributor in the overall health of the national economy, at the same time, they need a special impetus and help also from Government of India. So that has been the stated policy of Government of India. And that's why we are doing a deep dive into these benefits which are offered under foreign trade policy by the Ministry of Commerce. Yeah. So now, let's also understand the other backgrounds, the, 5 trillion dream economy that we have been talking about. So very categorically, time and again, the Prime Minister, the Finance Minister, and all the other critical ministers, in the present dispensation, UPA, NDA dispensation, they have categorically said that, we have to aim at $5 trillion economy. So clearly, Prime Minister recently stated that these 5 indicators, which are record production and procurement in agriculture, record FDI inflows, demand resurgence as shown by, growth in auto and tractor sales, improvement in manufacturing, and also addition to the EPF organization subscriber base. So all these 5 factors taken together, along with, I may add, the surge in collections of taxes, both direct tax and indirect tax. These, are symbolic of the fact that, the COVID era is over. All of us have had a difficult 1.5 years, but these indicators do seem to suggest that we are very strongly overcoming all of these. Also, repeated statements have been given by the Prime Minister about the optimism for future. How it is so very critical that we being third largest economy in terms of purchasing power, we also have to be transformed into the third economy in terms of the current US dollar pricing as well in the real sense. So, so these all indicate that, the tough time is over. We are definitely on the path of recovery, while in some of the other economies, the COVID-related concerns, are coming back. Fingers crossed, if that does not happen in India, or if that does, even if it does happen, it happens in a lighter way that will do a world of good so far as on, strengthening the path of recovery that we are talking about in the Indian economy's context. Yeah. Moving on, so far as recovery, COVID impact is concerned, and number of things, have been impacted in last 1.5, 2 years. Supply chain disruptions, all of us have seen inconsistent operations. The cost of raw material has gone, high to a great extent, including the transportation cost. Perishable inventory has had, some difficult times. Cash flow management has been, key concern. There have been numerous breach of contractual obligations as well, given that, many of the people did not have the relevant turnover. They did not have the cash to meet the obligations. And also, decline in sale proceeds collection. So all of these, factors put together, has had overall impact on a negative impact on the business. But as we did discuss on the last slide that, it appears that the tough times are over and, we are recovering sooner than later. Yeah. Moving on, again, one more indicator of recovery is, the wonderful numbers that we have of sales which had happened in the context of Diwali this month itself. So, it has been reported by various associations that, vis-a-vis last 10 years, this year Diwali sale, which is close to 1.25 lakh crores, has been remarkable, and it has beaten all the earlier records. Significantly, Delhi alone, accounted for 1/5 of this overall number. So these numbers look very, very, encouraging. It appears, along with the other 5 indicators that the Honorable Prime Minister indicated, did mean that, the good days are back again. Yeah. So with this background, the importance of MSME, we understood the difficulties that we had faced in COVID times and how we are back on the path of recovery. These are very, very critical. And now, keeping in perspective the MSMEs, their significance, and how they are, a backbone to the Indian economy, we will discuss some of the key benefits which are very much available to MSMEs. There are critically 2 aspects of what we are discussing. Number one, if we are in industry, it is so very important for us to analyze from our organization's perspective that, one, of course, we are earning operative profits from the operations of the organization. Apart from that, if I have contributed to the organization and therefore from the mandate of Government of India, there are certain benefits which can add to my bottom line, why not reap them fully and in an optimal manner? So for all our friends who are in industry, very, very important from them. At the same time, all of our friends who are practicing CAs or are into consulting, from their perspective as well, it will be very important to do a deep dive into all these benefits. As and when on a going forward basis, you examine somebody's balance sheet and you, see that there are no apparently benefits under FTP which are being claimed, then you can definitely suggest to them that, the hard part has already been done by them. Exportation, for example, has already been done by them. Foreign currency also has been brought into the country. It is just some compliance and documentation formality that needs to be done. And there are significant benefits that can be brought on table, if we do all this compliance. So let's understand under the foreign trade policy on a broad level, what we have done is we are saying that there are 2 kinds of export incentive schemes which are available. Number one, post-export schemes. where you have already undertaken the export, whether it is exportation of goods or exportation of services out of the country. There are three schemes, primarily as we speak today. One is in the context of goods, remission of duties and taxes on export products. So clearly, as a function of what HSN code you have for the goods that you are exporting out of the country, there is a defined schedule of roadmap, and this scheme has recently been introduced effective Jan 1 of 2021. Earlier, there used to be a scheme known as MEIS, Merchandise Scheme India, Merchandise Goods India Scheme. So this particular scheme has replaced that. And under this scheme, benefit is to the tune of anywhere between 0.0%, 0.01% to up to 4.5% of the export value of FOB that you are exporting. So say, for example, if you have exported certain products falling under Chapter 20 to the tune of 100 crore rupees, depending upon the schedule, if the rate allotted to your products is a 1%, then you are entitled for a duty credit scrip of 1% multiplied by your 100 crores. So 1 crore rupees of duty scrip shall be available to you. Now, somebody may say, what will I do with this duty credit scrip? We will discuss in greater detail. This duty credit scrip is already considered as a duty paid in advance by you. So later on, if you are importing certain goods into the country on which you need to pay a basic custom duty or custom duties, you can use this advance duty you have already paid. Or this entitlement of duty, you can sell in the open market as well. It is freely tradable, at a rate of anywhere between 90 to 95 rupees out of every 100 that you will give it to them. So 90 to 95 you can fetch in and cash it as well. So this is a scheme known as road tab. Thereafter, there is something called duty drawback. We will again do a deep dive under the Customs Act, Section 74 and 75 deal with duty drawback scheme. We will do a deep dive into that as well today. This, of course, is in the context of goods duty drawback. Now, on a similar footing, as in the context of goods, we have something as known as road tab. Likewise, we have something known as Services Export from India scheme, known as SCIS. So if I am exporting specified goods, I underline the word specified goods. So under the said notification relevant for this, there are prescribed services, for example, digital marketing, for example, accounting services, for example, consulting services, for example, consulting engineering. If I am exporting a specified scheme out of services out of the country and bringing foreign exchange, and also in order to provide that service, I am incurring some foreign exchange. So the difference between the two, that is the delta, shall be eligible for me, to be taken as a base for measuring this benefit. Now, this benefit, hitherto was available as a measure of 3%, 5%, and a 7%. For this fiscal year, for the last fiscal year, 1920, which has just gone by, a new notification has come a couple of months back in which, some curtailment of these rates have been done. So as we speak, depending upon the nature of the services, either a benefit of 3% or a 5% is typically applicable and available to you on the delta, that is the net foreign exchange that you have earned as a service provider who's exporting the service out of the country. Yeah. So what I am, discussing at this point in time is a very broad thing. We will do a deep dive into all of these schemes. What are the conditions? What are the limitations? How I can use, and what are the do's and don'ts also for these line items. Now, so far as pre-import benefits are concerned, similarly on the importation side as well, for guys who will be manufacturing something and exporting out of the country, for them also a benefit is available on the input side. Let's see what is that. One is EPCG. EPCG is typically used for capital goods. If I'm importing capital goods into the country and I'm paying duty, say 10% is the BCD, 18% is the IGST, or say there's SWSS as well. So typically I'm talking about paying, anywhere around 30% of a duty on capital goods. Vis-a-vis this, there's a scheme under FTP known as EPCG, which says that you can import these capital goods without even paying even a single penny to the government of India. So on one hand, you have this facilitation that you will not pay any duty while you import these goods into the country. On the other side, the flip side is then there is a corresponding obligation as well under the scheme. And what is obligation? The obligation is that whatever duty that you have saved, you multiply it by 6, and that the number that comes, that 6x number, that is the commitment you give to the government of India that I will be doing exportation of goods to this to the extent of this value. So if I bring capital goods into the country, use them, and say I make these mobile phones. So these mobile phones I have to export out of the country to the extent of 6 times of the duty amount that I have saved. Yeah. So that is EPCG. There are so many conditions. There are so many ifs and buts. We will, of course, do a deep dive into that. Likewise, for capital goods, if we have something known as EPCG, perimeteria for raw material is advance authorization. That is, if I have to manufacture a particular mobile phone, I import components which are used for manufacturing that mobile phone, say from China, from Malaysia, from Vietnam, so on and so forth. I can go for an advance authorization. There are sign norms fixed for this, and even if sign norms are not fixed, I can do an ad hoc declaration and get an advance authorization. It typically means that while I import these material into the country, raw material, I need not pay even a single penny to the government of India on the day of importation. No BCD, no SWS, no IGST, so on and so forth. But in return, there's a prescribed value addition which is given, and accordingly, once I make all the declaration on the advance authorization itself, everything is clear. If you are importing goods under this particular chapter of 100, these are the items allowed to you to be imported duty free, and you have to use this all and have to export, say, a value of 140 rupees out of the country. So this is how typically these schemes work. So on the left hand side of your screen, you have post export schemes, namely road tax, duty drawback, SCIS. First two pertain to goods. The third one pertains to services. On the right hand side of your screen, you can see pre-import benefit schemes, EPCG. For importation of capital goods, you're not paying any duty whatsoever, but you have a commitment to export the goods with a multiplier of 6 into the duties that you did save on the capital goods. Likewise, on raw material, you can bring raw material duty free, and thereafter, आपको value addition के बाद goods को export करना पड़ता है, which are the finished goods so far as the manufacturing concern is concerned. Yeah. So this was just a very brief snapshot. We will now do a deep dive into all these schemes one by one. Yeah. So let's do a deep dive with the most new scheme that we have on table. It is known as road tax. So let's spend a couple of minutes what the erstwhile scheme was, because then it will make sense talking about road tax and what was the genesis of road tax. Hitherto, a foreign trade policy, let me tell you, is applicable for 5 years. The current foreign trade policy had come into existence from April 1 of 2015, and it was valid up till end of 2020. But given the pandemic scenario and the challenges that it posed, the government of India, extended this policy, in bits and pieces, now up till March 31, 2022. So very important to understand, whatever we are discussing, it is applicable today. It shall be applicable, as we are speaking, up till at the end of March 2022. But as soon as the new FTP comes into the picture, effective April 1 of 2022, there will be some change in the forms and shapes and characters of these schemes. We may then, have another session and enlighten the august audience on, those benefits as well, once these foreign trade policy will be revamped. So let us understand about MEIS. Hitherto, there was a scheme known as MEIS. This scheme said that whenever you are exporting goods out of the country, there were different categories as a function of under which HSN your goods were falling and under which bucket the countries were. There were 3 categories of countries, category A, category B, and category C. So as a function of the HSN code and the country and the bucket in which the country was falling, you were either entitled for a 2% benefit or a 3% benefit or a 5% benefit. That was MEIS. Yeah. What happened was, thereafter, the US authorities, custom authorities, they had filed a case against India at the WTO forum. They said that so far as these MEIS and other benefits given by the government of India are concerned, they are ad hoc benefits and they do not confer with the law as prescribed by the SCM agreement of the WTO. So there were rounds of litigation, etc., which were conducted at the WTO fora. And eventually, even the preamble of the FTP was read, which clearly said that these benefits, MEIS in particular, is given in order to take care of the infrastructural inefficiencies in the Indian context. So the overall, theme of this was, and the end result was that India lost the case. India, failed to prove in front of the authorities that these taxes are these benefits are reimbursed in order to negate all the non-convertible taxes which are there in the cost of manufacturing the goods. For example, if you manufacture something in the present context, you have something called electricity duty, you have something called 17.5 GST credits which are not available to you. You have electricity duty while you buy fuel for GTA services or for your truckers. There's importation which is happening from the port up till your factory, and there is again GTA movement, goods movement which is happening from your factory up till the port for exportation. So there's fuel also which is involved, and as we all know, on petroleum and diesel, GST is not applicable. VAT, CST or excise duty is applicable on the fuel part. So these are all taxes and duties which are very much getting debited to the profit and loss account today, but they are not available as a credit so far as the scheme of things and the GST law are concerned. So all of this rationale, we could not prove there that this particular benefit was indeed to negate this, and therefore, when the scheme of the SCM agreement, when these preambles and then when these rationales were put together before the WTO by the US authorities, and we could not really counter them, the WTO pronounced that so far as these benefits are concerned, they are not in terms of the SCM agreement, and therefore they have to be discontinued within 60 days or 120 days. And these days were referred for the varied kind of schemes for which this litigation was started. So that paved the path for Government of India to think that the MEIS benefit in the form and shape as they were being given to the exporters can no more, be the norm. So because we have to adhere to the WTO rules, therefore we will have to do a tweak in this scheme. हमें इस scheme को थोड़ा सा रूपांतरित करना पड़ेगा to take care of the fact that this benefit, which we are giving in terms of MEIS or now the road tab, should only be to negate the inefficiencies of the taxes that are there in the costing. So जितने भी tax का साहब हमें credit नहीं मिलता, सिर्फ उसको नेगेट करने के लिए ये बेनिफिट मिलना चाहिए, इस तरह का प्रोपोजिशन टेबल के ऊपर आया, एंड दैट इज वेयर द रोड टैप स्कीम came into existence. Couple of it took government some time. There were road tap committee formulated in July of 2020. A lot of representations were asked through body associations to be filed by the organizations, be it the chemical or all the sectors, chemical sector, iron sector, and all the other sectors, and everybody forwarded their data. They said that, if I'm exporting 100 rupees goods out of the country, this is my costing, this is all the rationale. And if you, do a deep dive, at least 3 to, in our analysis also for varied sector, we saw that anywhere between 2.5 to a 5.5 were indeed the, tax cost, which were not available as a credit. As I did say, some of the examples, electricity duty, that I'm consuming, on that there is something that I pay as electricity duty. So अगर 100 रुपए का आपको इलेक्ट्रिसिटी का बिल आता है तो 9 से 10 रुपया हर स्टेट के अंदर इलेक्ट्रिसिटी ड्यूटी का चार्ज होता है. Now that is one line item. 17.5 credits, which are negative line items under GST, those are other line items. Other than that, you have something called a mandi tax, say, in a food processing regime. You have something called stamp duty. So all the taxes, cesses and duties which we have been paying either to the state government, central government or the municipalities, we computed all that and we said, see, if 100 rupees goods I am exporting, 80 का मोटा मोटा मेरा cost है, 15 रुपए 10 रुपए ₹15 मेरा मार्जिन है, 95 और ये ₹5 का जो टैक्सेस का कॉस्ट है जो आपको हमें रीइंबर्स करना चाहिए था इन द फॉर्म ऑफ क्रेडिट, but unfortunately the GST law does not permit that set off, and therefore this ₹5 you should reimburse to us in the name and shape of road tap. Then there was a detailed meetings with the road tap committee of the association clients. We went again and again to the drawback section also, which was the facilitation and nodal agency for doing this working as well from the ministry of finance. So they eventually issued a notification on August of 17th, and they came up with very minuscule rates. The government of India came up with very minuscule rates. In some of the cases, I can tell you, if the erstwhile benefit under MEIS was 5%, road tap rate was as minuscule as 0.5% or a 0.8%. So if, for example, my profit and loss account earlier spoke of MEIS benefit to the tune of 10 crores, वो सीधा कम होके 1 करोड़ पे आ गया. So that was the impact of road tap. So now clearly there is a schedule in place for most of the sectors. Some sectors intentionally have been left out in the first go. Typically, chapters from 24 to 31, they have been left out. And likewise, chapter 72 and 73, they pertain to steel, iron and steel, they have been left out. And some of the chapters 61, 60, 61, 62, which are textiles in nature, for which there's a corresponding benefit other than road tap has been pronounced, and therefore they were not kept under the road tap thing. So this was the background why MEIS was there, why it was pronounced as something which should not continue by the WTO fora. And this is how the road tap thing came into existence. Now, what has happened is, post this lesser rates announced by road tap, again, the road tap committee has been reconstituted. What was also done while the road tap committee, pronounced these rates, some of the sectors were neglected. Again, some of the line items were neglected. For example, people who were advanced exporters, who were advanced authorization holders, who were importing the raw material under advanced authorization and exporting the final goods, they were also kept out of the road tap benefit. Likewise, EOUs were kept out of the road tap benefit. Now again, many representations were filed that while you are not giving advance authorization benefit, there's no logic in taking away road tap, because the both benefits work in a different realm and with a different background. Both ideally should have been given, and same was the case in the erstwhile regime as well. In the erstwhile regime, both MEIS and road tap and advance authorization were given, so there was no logic to deviate with the same logic in the road tap scheme of thing, especially when the road rates are much lesser than the MEIS rates. So it didn't make any sense. So many representations were filed, and very recently, 20 days back, the road tap committee has been reconstituted to look into data and numbers of these entities who are advanced authorization holders, EOUs and SCZs. Now there will be another set of meetings, data crunching and data submission, wherein a detailed dive will be done as to what should be the road tap benefit given to these guys, who were left out in the first go. And also likewise for chemical sector falling under chapter 28, 29, iron and steel 70, 72, 73, they are also filing representation that there is no rationale. If road tap is to remit the tax costs which are not available in the cost, if it is, a cost for business X, it is a cost similarly for us also in this sector. And if the rationale for giving road tap is that you want to negate the unsalvatable taxes, then this rationale equally applies to the sectors which have been forgotten in the first tranche. So therefore, they are also filing representation. And it appears, in the background, some bit is happening on these requests as well. So this is the overall context of road tap. Can we move ahead, Ketan? Yeah, so this I have already, discussed what are the various taxes, which were taken into consideration while evolving a rate of road tap, which I filed as an entity, which should be applicable on my HSN codes. So these are those, components which I ought to have considered. And what we are also doing, and what our, fellow CF friends can take a leaf out of. What we are also doing, the formats which were earlier given for this R1, R2, R3, for this road tap working to be filed by companies, we are doing this exercise yet again. especially for aggrieved parties who believe that they did not get the right rate of road tax they ought to have been given in the first tranche. So we are doing this exercise once again for them, and we are filing an application, a reconsideration application for revision of these rates as well. So there are provisions under the FTP. When these provisions and notifications of road tax came, there were para 4.54 and para 4.55 of the FTP, which clearly said that later on there could be a reconsideration of these rates as well. So a similar trade notice has also come, that where there is a real anomaly in the rates which were announced in the first tranche, organization and association can come back, and road tax committee will be happy to look into that. Yeah. Can we move on, please? And this again, it's a snapshot of all the taxes and components which I have already explained, along with the brief of road tax that we have discussed. So, so far as number crunching is concerned, what you have to do is, if you want to really find out what exactly should be the ideal road tax available on your products. So very simple, you have to pick up the value of 100 rupees of exports, and you have to backwork and see what exactly is the real cost of the raw material and of the services of the processing, which I'm incurring. What is the margin that, I have to keep, and, while you analyze all your ledgers, cost sheets, etc., you will come out with items that we have discussed: mandi tax, electricity duty, 17(5) credits, and you can compute that in your sector, in your supply chain, what effectively is the number which ideally ought to have been available as a credit, given that these are taxes or duties or cesses of one form or the other, but for the limitation under the GST Act that are not available as a credit. So I can always compute that अगर मैं 100 रुपए का एक्सपोर्ट देश से बाहर कर रहा हूं, तो क्या वो 3 रुपया, 4 रुपया या 4.5 का नंबर है इन सब एलिमेंट्स की कॉस्टिंग को मिला के, टैक्सेस की, जो मुझे गवर्नमेंट के पास एक बार जाके आई शुड अगेन नॉक द डोर्स ऑफ द रोड टैक्स कमेटी एंड रिक्वेस्ट देम, साहब मेरे को ये रेट मिलना चाहिए, आपने 0.8 दिया है, आई एम हैप्पी to give submissions and all the detailing of this. We request you to kindly look into the numbers yet again and give us a fair hearing, and thereafter revise our rate if you concur with our position and our request. Yeah. Yeah. So again, it's a deep dive of road tax, the gist that I discussed, notification by notification, and what is the procedure, and so many other nuances and important points that we need to take care while applying the road tax benefit. I hand it over to my colleague Ketan. He will take all of us through these notifications and the related significant nuances. Ketan, over to you.
All right. Thank you so much, Rajat, for so beautifully explaining this scheme. This is indeed, one of the hot picks these days in this country for everyone who is engaged into exports as an industry, as well as, my fellow professionals who are serving their clients. This is also one of the schemes where you have the opportunity to show the actual value addition in terms of quantified numbers to your client. And, that's exactly when your client doesn't mind taking up your services. It's equally true for, your own organization. Somebody is coming from the industry as well. That, an added benefit is always an added advantage, and nobody bothers. Nobody is, is really wary of not having an additional benefit. So, before we move on to the developments till there and the processes, I just wanted to highlight one particular point here. In the erstwhile MES scheme, which was actually given over and above all the other benefits such as, your advance authorization, duty drawback, be it EPCG or any other scheme that you may be having, MEIS was available over and above all of these schemes. As a matter, what happened is the moment your customers, like, the overseas customers came to know of the fact that, your supplier sitting in India is, getting some kind of additional advantage from their government, they started negotiating the prices. So what started happening is, if you get 5 rupees from your government, your customers started, calling out, okay, you share that benefit with me. Your baseline still remains the same. You get 2.5%, I get 2.5%. And that's how the money that government had secured for promoting the Indian industries was actually being siphoned out of the country. At least a part of it, a substantial part of it. And as you would know, if you are, really willing to generate your business, you would, of course, wouldn't mind, sharing that benefit with them. And that really frustrated the very purpose of why MEIS was introduced in the first place. It was meant for supporting the Indian industry, but in the end, what happened is it only partly served the purpose, and a lot of the benefit was actually being taken away by your customers. So that was also one of the reasons why MEIS was scrapped out. In fact, Government of India didn't really much bother to fight out the case at the WTO. It indeed did as much as it was necessary, but beyond a certain point, it realized that it's only wise to actually transition from the MEIS to a scheme that has a rational basis to give the benefit to Indian exporters. Now, quickly taking a snapshot, although Rajat has taken us most of the parts of, or rather the conclusions of all these notifications. On 1st of September 2020, benefits under MEIS were announced that it will cease to be given to the Indian exporters from 31st December 2020. And from 1st of January 2021, any export will not attract the benefit of MEIS. Another press release came on 31st of December 2020, which says that roadmap benefit to be available QA exports from 1st of January 2021. So basically the cutoff date was fixed on 31st of December 2020 for MEIS, and a trigger date was fixed on 1st of January 2021 for roadmap. Another notification came up that said that roadmap scheme formulated under the foreign trade policy along with prescription of product-wise rate. Now, product-wise rate is an important term here. For major GGI products, roadmap rate of 0.01% pegged at the FOB value was notified, while for imitation jewelry, rate of 0.5% was notified with quantity of cap. So it also provided for a upper cap of how much benefit that you could reap out of these schemes. Now, again on 23rd September 2021, notification was issued that specified the manner of issuance of duty credit and additional restrictions and conditionalities associated with roadmap. Again, another circular came up which specified that procedural aspects associated with the administration of roadmap scheme. What really happened is this circular specified or rather clarified the process that was already set out by the notification issued on 23rd September 2021. And like I said, it is really going to be a value addition proposition. So we also thought to take you through the process that they have narrated for us to follow, and that's how we have tried to capture it for your quick reference. Now, at the export stage, an exporter has to opt for roadmap benefit at the stage of filing the shipping bill itself. It has to declare its intent that it wants to avail this particular benefit. And it can also be done. It can be done only for the eligible exports. So up to the point on 17th of August, when the rates were declared, the process was later on announced in September month. This was all in place. But for the exports that was already made from 1st of January 2021 up to August, what would really happen? Would they really get the benefit or not? So these clarifications clarified that they would indeed get the benefit, but at the rate that is declared on 15th of August. So at the time of export, there were guidelines on the January of 2021 itself that an exporter must mention its intent to claim the roadmap benefit on the shipping bill. Now, in the second bullet, we see that exporter has to make a declaration on the electronic shipping bill to the effect that it would abide by the scheme provisions and not claim rebate with respect to levies already exempted or remitted. So that was one of the conditions that was put forth in that clarification. Now, after an EGM is generated, that is electronic generic manifest, the system directorate commences the processing of roadmap. So at this point in time, you already have exported the goods, you have filed your shipping bill, you have also declared your intent to avail this scheme, and the system begins its operations. What it does is it commences the processing of roadmap, and a scroll is generated in the customs automated system, which contains all the necessary details of the material that has been exported, the shipping bill numbers, the value of the exports, the entitlement of the benefit, and all of related information. And this claim is also subjected to RMS, your risk management system. So if you're exporting particular product, then risk management system will also analyze whether those exports are really valid exports for the purpose of roadmap or not. And then only it will allow you to compute the roadmap benefit. Script generation, post scroll generation. So once the scroll has been generated, the exporter will have the option of combining the duty credit scripts available in a scroll or a number of scrolls at a particular custom station of exports and generate an e-script in the exporter's electronic ledger maintained in the customs automated system. So to sum this up, what happens is if an exporter is exporting multiple shipments from one port, or he is exporting multiple shipments from multiple ports, then there will be multiple scrolls that will be generated. And that particular exporter then will get an option to actually take a look at of all those scrolls generated, consolidate all of them into one, and then generate its own e-script that can be utilized by him for the purpose of later basic payment of basic customs duties. Now, why this kind of system has been implemented? Why couldn't there be a script issued at the pegged at the each export? So it is also relevant for somebody to analyze the liquidity of the script. If somebody wants the script in bits and pieces that he can utilize at the convenience of him, then he could do so, because utilization of script has also its own limitations. While you could debit those scripts as much as you would want for the purpose of payment of basic customs duty, these scripts are also transferable. And if one wants to transfer these scripts, he cannot partly transfer those scripts. He has to transfer the scripts in its entirety. If a script is issued of a value, say 100 rupees, he can transfer the entire script worth 100 rupees. He does not have the option of transferring only 50 rupees out of that script and retaining the balance 50. So that is also the reason where exporters are given an option to see how many scrolls they want to combine and how many scripts they want to issue for themselves out of the entitlement. Now, moving on to the next aspects of time period for script generation. The exporter has the option to generate e-scripts within 1 year of generation of the scroll, failing which the available duty credit in each scroll shall be combined customs station wise and sent by the customs system to the electronic ledger of the concerned exporter as an e-script. Simply putting, the day script is generated, the scroll is generated, exporter has an option, exporter has a time of 12 months to decide how many scripts of what value he wants to generate. If he does not utilize his option, then the entire thing will be decided based on the system allotment, and those will be credited to the electronic ledgers of the exporters. Now, once the script is issued, what is the validity of that script? So the validity, simply speaking, is of 12 months. We are at point number 2. An e-script shall be valid for a period of 1 year from the date of its generation in the electronic ledger, and any duty credit in the said e-script remaining unutilized at the end of the said period shall lapse. This is very, very, very important point. If you're not utilizing that script within a span of 12 months, whatever benefit that you have sought for will lapse. It does not have the option of carrying forward. Now, you would ask an obvious question: how do I really mitigate this kind of an loss? Because my imports are going to be pegged with my supply chain. It is not really going to be dependent on whether I have a script and whether should I utilize this, and therefore should I import the material or not. It is all the driving factor to decide whether imports are to be made or not is always going to be decided by your supply chain management. Script is always going to be secondary to whether you want to import or not. So how do you use this situation to your advantage? One of the very important aspects of script is that those are transferable scripts. Like I said earlier, those are transferable scripts and you can actually sell them in the open market. So there are always players, some bigger players who would constantly, keep on importing. There are players in the market who file bill of entry almost on a daily basis. And these are the players who are actually interested in, taking up those scripts and utilize that. Now, again, another question pops up. Why would they do so? What really the benefit lies into the picture? The fact that you are actually importing those, you're actually getting those scripts, it also means that you get to sell them. You get to sell them and the buyer will buy those scripts at a marginally discounted price. And that's where the benefit of your buyer also lies. Allow me just a moment. I think there is some video connectivity issue. All right. Right. So we were at the point of transferability of the script, and the benefit of the script is that these scripts can be bought and sold in the open market. the script holder has to actually subscribe those scripts to your buyer at a particular price that can be negotiated between the parties. Typically, these are slightly discounted prices, and that's how your buyer also gets the benefit, and the seller of the script also gets to liquidate all the script value that he has reaped out of this entire system. Now, coming back to the process, there are some quick factual procedural aspects that one has to ensure before getting into this whole process. Is creation of electronic ledger. An electronic ledger shall be created for an exporter claiming road tape or a person who receives road tape script pursuant to transfer. Very simple to understand. Electronic credit ledger must be created. Then script generation. Once a script is generated, it shall be registered automatically with the customs station of export. So this is also registered with a particular customs station, and then it also gets a unique script number and transaction visibility. Each e-script will carry a unique identification number and date of its creation. All transactions made in the ledger of an IEC holder through credit, debit, transfer of duty credit shall be visible on the said IEC holder and customs authorities. So any transaction that has happened over a particular script is visible for that particular script holder at any point in time through his customs interface. So these are one of the key aspects of how to claim the road tape and what benefits one can reap out of it. Again, before we move on to the further parts, it is also important to see what are the articles, or rather the kind of transactions that are kept out of the ambit of road tape. Restricted items, something that has been restricted for the export itself for obvious reasons. You don't get any benefit. As a matter of fact, restricted items cannot be exported in the first place, and if you still have, then you cannot really in a position to ask for any benefits out of that. Transshipped items. All the export products must have been manufactured in India. If you are simply importing these products from somewhere else in some other country and exporting to some other country, then that is not eligible for road tape benefit. Again, deemed exports, supplies to advance authorization holder, supplies to SEZs, supplies to export-oriented units. All of these units have the mandate of exporting the products out of India. And if you are making a supply to these particular entities, then you are not entitled for the benefit of road tape. Like I said, products under advance authorization, EOU exports, these are again the subsets of deemed exports itself. FPZ, EPZ, SCZ, again the same category, they have the mandate of exporting the products. Exports from non-EDA ports, airports, CFS, LCS, land custom stations. So the non-EDA ports are actually the ports where your system is not yet operational in a digitalized manner, and therefore you do not have the option of claiming the road tape, because the road tape system is really being managed through its own interface, and those interfaces not having been available on these non-EDA ports, it is difficult for the government to facilitate the road tape benefit for the exports made from those ports, and therefore one has to always make sure that it is actually making the export from an EDA port to make sure that the benefit is available to them. Then goods used after manufacture. In a way, a second-hand good, if exported, will not be eligible for a road tape scheme. Once manufactured in India, it has to be exported as a fresh product. If it is used in India and then exported, then it is kicked out of the road tape ambit. Again, products manufactured in ESTP and BTP. The same logic applies as an SCZ or EOU. They have the mandate of making the exports, and therefore supplies to these entities are kept out of the road tape benefit. Some more restrictions. We saw that road tape rate is decided based on a percentage applicable to a particular HSN code. Now that particular percentage is multiplied with the FOB value, free on board value of the export product. And how to consider this FOB value is also regulated by these provisions. What they say that this FOB value cannot exceed 1.5 times of the market price of such goods. Say for example, if a particular pen is being sold in India for ₹10, and for some reason you identify a customer, an overseas customer who is willing to buy, or you have somehow made sure that he can purchase that particular pen at a value of ₹50, then in a normal case situation, your FOB value will be treated as 50 rupees, and that alone will be treated taken as a base for your multiplier of road tape rate benefit. But because of this provision, a pen which is otherwise sold in India at rupees 10 cannot be valued more than rupees 15, that is 1.5 times of its market price in India, for the purpose of road tape. You may fetch a price of rupees 50 from your customer, but your claim for road tape will remain restricted at rupees 15. So this is a particular restriction given into these provisions. Now, this provision doesn't really go along with the basic tenets of FTP. The basic tenets of FTP say that, whatever value you are fetching has to be multiplied with the road tape rate that the government has decided. It is not really at the liberty of deciding a cap, or really not at the liberty of deciding what the assessable value should be, because its basic role of the road tape committee was to decide the actual rate of road tape, and not to determine the assessable value for the purpose of road tape. These are two different things. The rate and the assessable value are completely different things. And therefore, it feels like, they may have overstepped their authority, and this is likely to see some challenges in the coming days. So this is one of the restrictions that the road tape scheme has. Secondly, realization of export proceeds. The idea of road tape was to promote international trade, the exports from India, so that we get the foreign exchange. Now, if a particular export doesn't really fetch the foreign exchange itself, then the entire scheme or the purpose of the scheme is not really achieved. And therefore, if there is no realization of export proceeds, road tape cannot be claimed, or the claim of road tape cannot succeed. The scheme also says that it is not only the export proceed of the particular export for which you are claiming the road tape, but also any prior export that you may have made and on which the export proceeds have not been realized, then also your claim for road tape scheme is restricted. So that is a little going a step ahead than what the scheme really says for, but then in an interest of the country's economy and the interest of the very purpose of the scheme itself. Now, moving on to cancellation and recovery of benefit. There would always be situation out of 10, statistically speaking, there would always be one or the other guys who would, end up taking an aggressive position or rather, stepping out of the bounds of the road tape scheme itself and claim the benefit, and would also be successful in getting those. We ourselves have, in fact, taken up few matters where, SES claims have been, kind of offered by some of the consultants in the market, who said that, we will get you the scripts, we will get you the SES benefit, your scheme really fits into particular this category. And eventually it was found out that, the scheme did not really fit into the category. And the government then went after all these people who have claimed this SES benefit. This was mainly from the logistics companies, and who were, claiming the SES benefit on getting the foreign exchange for the logistics arrangements. And a huge amount of demands demands running into crores were actually made. So this is also one of the areas of concern, where one has to make sure that the SES claims are really valid and no proceedings are actually initiated for its cancellation or recovery later on. Because every time it happens, it comes with its own dracona of interest and penalties under FTDRA are really huge. So it is really very important that one takes caution that these schemes are really utilized only and only when these are entitled, the exporters are entitled to it. Now, moving on to the next aspect is road tape to be claimed at the time of making the export by providing an appropriate declaration at an item level in the shipping bill or bill of export in the customs automated system. Then prior eligible exports, those made from 1st of January 2021 onwards, the claim shall be granted on the basis of shipping bill of export, given that the order permitting clearance and loading of goods for exportation has been made. This is a specific condition because the scheme is announced to be effective from 1st of January 21, but the rates have been announced in August, while the processes have been announced in September, and the entire system is yet to come into picture or come into run in its 100% efficiency. So this kind of a provision for exports that are made earlier. And the credit claim shall be allowed by the customs authorities after necessary checks, including RMS. We discussed this earlier. RMS is the risk management system. The duty credit shall be available and usable on exports and imports undertaken through EDI enabled ports. We also saw this aspect. duty credit pertaining to exports made to Nepal, Bhutan, and Myanmar shall be allowed upon realization of export proceeds. So this is also another subset of ensuring that these schemes are actually resulting into realization of export proceeds. Now, moving on to, so this was all about the road tax scheme as we spoke. Another scheme that ensures benefit, or rather it makes sure that the taxes are not really exported along with the export products, is duty drawback. And I would request Rajat to explain the basics or the foundations of how duty drawback functions. Over to you, Rajat.
So thank you so much, Ketan. So we did discuss, on the snapshot slide that so far as goods are concerned, one benefit post-export we have road tax. The other is duty drawback. Now, what is a duty drawback? There are two provisions in sections 74 and 75 under the Customs Act. Section 74 says that if I have imported certain goods into the country, I may have used those goods or I may not have used those goods. Those goods, the same very goods, when re-exported out of the country, these goods are covered within the ambit of 74. When I would have originally imported it, I would have paid custom duty. So while I am exporting these goods back, which is known as re-exportation, whatever duty I had paid, multiply by a formula, is the duty that I will get back from the government of India in the name and shape of duty drawback. That is section 74 for us. There's a particular notification which says that 98% is the maximum duty refund that you can get on the count of duty drawback vis-a-vis the duty that you had paid. That's one. And there's a schedule. If the goods are going within 6 months, if goods are going, beyond 6 months, but within 9 months, if they are being exported within 12 months, then, the depreciation rate kind of applies, and the duty component which comes back to you in the form of duty drawback reduces. अगर मैं 6 महीने में वापस भेज रहा हूं तो मान लीजिए मुझे 60% मिल जाता है वापस. अगर मैं 9 से 12 महीने में भेज रहा हूं वापस goods तो वो 40 पे आ जाता है. So that kind of a schedule is there under the rules. So Section 74, read with the specified rules, we have to ensure that, we have to satisfy the relevant officer that these are the same goods which are re-exported. They are the same goods which were indeed imported into the country. So bill of entry or shipping bill के अंदर हमें correlation दिखाना पड़ता है, and we have to satisfy the officer, and upon production of various documents, certificates, and satisfying the officer, we get the duty drawback from the government of India. Now, the second scheme falls under the ambit of section 75. It says that I can import the raw material into the country, I can process that raw material, and thereafter I export the finished goods. So while I import the raw material into the country, I pay applicable duties. Basic custom duty, SWS, IGST, as the case may be. IGST, of course, is available as a credit, as we know. So whatever duty I had paid, now I have the finished goods, and goods are going out of the country in different form and shape. Now, there are two kinds of drawbacks typically which are available under section 75. One is standard rate, which is known as AIR, all industry rate. So there's a schedule in place. It says that, if your product falls under chapter, say, 3904, then you are entitled for a duty drawback at the AIR rate of 1.3%. And that's defined. The duty drawback team has done the past analysis. They know what typically the supply chain is, what is the BCD component and other cesses component. Therefore, what is the value addition, and what ideally on a pan-India basis should be one single rate applicable to you. That is AIR. Now, within section 75, where I import raw material duty paid, process the same, and export ultimate goods out of the country, which is my FG or finished goods. If I feel, as per the law, that whatever rate is being given as AIR and whatever I actually calculate, AIR say is X, and what I actually calculate is the duty incidence, which is not which I should be getting from the government of India, is Y. If your X, which the government is giving, is less than 80% of what you should be getting as per your computation, the BCD that you have paid, the cesses that you have paid, मान लीजिए आपका कहना है कि वो 20 रुपए मिलना चाहिए एक प्रोडक्ट के ऊपर, गवर्नमेंट का कहना है कि नहीं 15 रुपए मिलना चाहिए एज पर देयर EIR रेट, then the differential is the amount the government is suggesting is less than 80% of what you believe as per your numbers and facts. In such a case, we can, file for something which is known as a brand rate fixation. So there's a, special mechanism where post exports, I can produce the BOM in detail, all the shipping bill details, all the bill of entry details, why day which I had, imported the goods. I can produce a correlation of the BOM. कि मेरे एक प्रोडक्ट बनाने में ये इतना केजी लगता है, ये एक कंपोनेंट लगता है, and accordingly I can depict that for exporting every component of 1,000 rupees, the BCD and other cesses, other duties, I ought to have been refunded 20. इस तरह का calculation करके we have to go and knock the doors of the relevant authorities at the port, and then they, on the basis of all the documentation, affidavits, and all the relevant backing and CS certificates that we produce pertaining to our costing and otherwise, then they give us the benefit of brand rate fixation. So within 74, of course, a deep dive again we will do. I request Ketan to, take us through all the nuances in great detail. So section 72, the same goods are exported out of the country. 75, two things. One, AIR simple, raw material India may lie, duty paid, and ultimate product we are exporting out of the country. If I want to go to for the normal rate, AIR, and if I feel I ought to be getting a higher rate, and the difference is that what government is giving is less than 80% what I should be getting, then I go for a special calculation, and that is typically known as a brand rate fixation. Yeah, Ketan, over to you.
All right. Thank you so much for setting out the background. Now, the benefit, as we see, is broadly bifurcated and under section 74 and section 75. 74 mainly speaks of re-export of duty paid goods, and section 75 speaks of material manufactured out of imported raw material, and then which manufactured goods are then exported. So let's quickly take a look at section 74 and what its contents are. The goods should have been imported into India, of course. The duty of customs should have been paid thereon. So the duty if paid, only and only then the drawback becomes available for re-export. The goods should be capable of being easily identified as the goods which were originally imported. They must not have changed their shape, character, or the identity per se. The goods should have been entered for export either on a shipping bill through sea or air, or on a bill of export through land, or as baggage, or through post and the proper officer, after examination of the goods and after ensuring that there is no prohibition or restriction on their export, should have permitted clearance of the goods for export. So multiple things. It should have been verified for an appropriate import, and also it should have been verified for an appropriate export, simply speaking. And once these things have been ensured, then one can fit into section 74 and the drawback allowed under that particular section. Then moving on to second last bullet point of this particular section 74, the goods are identified to the satisfaction of the assistant or deputy commissioner of customs as the goods which were imported. So the link of, or rather the one-to-one link of the material imported and the material being re-exported must be established for the purpose of drawback under 74. Goods are entered for export within 2 years from the date of payment of duty on the importation thereof. So this drawback under section 74 is available only for a period of 2 years from the date on which you may have paid the basic customs duty and other duties on the imports of that particular goods. So there's a limitation of 2 years for this kind of a drawback under 74. Now, moving on to section 75 drawback, which is the most popular or the widely used drawback mechanism in India, where goods are manufactured in India and then exported. The provisions speak of the goods exported are totally different from the imports. So there has to be a value addition. The raw material must have been imported and the finished goods must have been exported. So manufacturing process must have been undertaken by the exporter over those inputs. Then the input could be either imported goods on which duty of customs has been paid, or indigenous goods on which central excess duty has been paid. So domestically procured raw material also, as well as imported raw material as well. If is used for manufacture of export goods, then the drawback can still be claimed. The existence of the imported or indigenous excise duty paid goods in the final product is not capable of easy verification at the point of export. So if it is difficult to identify how much raw material has been imported, how much raw material has been actually domestically procured, when you are actually presented these goods at the the export. And therefore, it is important to maintain the documentation that ascertains the percentage of raw material that has been domestically procured, the percentage of raw material that has been imported, and that has gone into the manufacture of exported product. Then goods, namely the inputs, might have undergone changes in physical shape, property, etc., and that is fine. That is expected. As a matter of fact, our Delhi Cloth Mills decision of Supreme Court lays down the tenets of what manufacture means, and it says the change in name, character, and use. So if the drawback is pegged with the fact that manufacture must have taken place, it is obvious that it will undergo the changes of physical shape and property, and that is completely acceptable. Then the quantity of inputs per piece of final product may not be uniform and may not also be capable of verification at the time of exportation, and that also is fine, because the only condition for which the drawback functions is that it must have been manufactured in India out of the raw material that has suffered the duty. So the drawback ensures that whatever tax cost has been suffered over the inputs is actually rebated back to the exporter, because the finished goods have been exported out of this country. Again, functions on the same logic that taxes should not be exported with the export of goods. So these are the conditions under section 75. Now, the drawback rules that have actually been introduced also has one of the condition of usage of the product manufactured in India. And that is very, very important, because these days there is, a list of, or rather a line of investigations that is being conducted by DRI on a particular industry, which is mobile handset industry, in which what has happened is, you may all be aware that mobile handsets, when supplied by OEMs, the manufacturers at times are also locked for being used in a particular territory. And when that happens, the mobile phone can only and only be used in that particular territory, or it can begin its usage in that territory, if I may have to correctly say. And once that initiation of usage has happened, only and only it can be taken in an outside country. So many mobile manufacturers have actually restricted its mobile phone usage in India, which means that mobile handset cannot be sold outside the country. But many merchant exporters or traders who have identified some areas where they can sell these phones, because the OEMs have not introduced those particular models in those jurisdictions, they can purchase from OEMs or the local wholesalers or the traders or the e-commerce platforms, and in turn trade into those countries. But before they do so, what they have to do is they have to use, or rather they have to register that the phone has been used in India. If they do not do that, then they will not be able to export that product, or rather that phone will not be capable of being used in that overseas jurisdiction. So they have their own processes set up, in which they unbox the mobile phone, they insert a SIM card, they make a call for a particular time period. Once that has happened, it is registered for the purpose of OEM that it has been sold in India. And then again, the phone is repacked in the box exactly in the same way the OEM has packed. And then these mobile phones are exported out of country. Now, a typical case is whether that 2 or 3 minutes call will be treated as use of the mobile phones or not has been the point of contention. What happens is these businesses are working at a very slender margin, and therefore getting this drawback means whether their survival is whether they are able to survive in the future course or not. If they do not get the drawback benefit, their margin is eroded, and their model doesn't remain sustainable enough, and their business would collapse. But if they get the drawback benefit, their model will in turn sustain. They will keep on getting the foreign currency for the country. They would keep on generating the employment. So in all the moral aspects, it is something that should sustain in the longer term. So that is how the business model functions. And now the DRI has started their investigation interpreting the term use as they have used in the, or rather they have provided in the drawback rules under section 74 and 75, section 75, and they are now challenging the availability of drawbacks. So this is just one of the aspects that I thought, I should just point at before we move on to the next slides. Now, drawback not to be allowed in certain cases. If the export value of finished goods is less than the value of the imported material used in the manufacture or processing of such goods, or carrying out any operation on such goods or class of goods. Very obvious, because the scheme is meant for ensuring that we get foreign exchange. If you are spending more foreign exchange than we are getting that, then the benefit will not be available. The second is the export value is not more than such percentage of the value of the imported materials used in the manufacture or processing of such goods, or carrying out any operation on such goods or class of goods as may be notified. This is again, as more or like this first condition itself, but meant for the notified products. Then if the sale proceeds in respect of such goods are not received by or on behalf of the tax exporter in India within the time allowed under the Foreign Exchange Management Act, FEMM, linked with again the fact that, foreign currency realization must have happened, and if that is not happening, then the benefit will not be allowed. And that's when the FEMA provisions comes into picture to dictate the limitation in which the realization must have happened. So that is the basic idea about duty drawback, which was the second scheme that we saw today, which is meant for export of goods and which is based on post-exportation, which is based on an event of post-exportation. Now, going ahead with the third scheme, which is linked with again post-exportation, is services export from India scheme. The clear difference between the first two schemes of roadmap and drawback versus this SCIS is that SCIS is meant for services export. Now let's take a look at what exactly it is about. The government of India launched this foreign trade policy of 2015-20, and which had its own ideas about improving how Make in India vision and generation of employment, increasing value addition for the domestic manufacturing, so on and so forth. And in that, they introduced the scheme of SCIS, effective from 1st of April 2015, and originally meant to be operative till 31st March 2020. It still is operative only until 1920. And although the foreign trade policy has been extended for another 2 years, there is still no clarification whether this scheme also will see an extension for another 2 years with effect from 1st of April 2020. That is still something that needs to be looked at. Then SCIS provides rewards to service providers of notified services. Notified services is an important term here. Not all the services get this benefit. We will take a look at the restrictions in coming slides. From 1st of April 2015 to 31st December 2017, the rate of rewards were pegged at 3% and 5% of the net foreign exchange earnings, depending upon the nature of services. Now, net foreign exchange earnings is also an important part here. Like Rajat already explained in the initial few slides, that SCIS benefit is given on the difference, the delta between the foreign exchange spent for providing these services versus the foreign exchange earned out of providing these services. Only on the difference you get the benefit, and the percentage was 3% and 5%, which was further revised in 2017 to 5% and 7%. So the benefit was increased. A lot of representations were made telling how this is beneficial and needed at the time, and it was done so. The list of services rate has been reviewed again in April 2019, and some of the products have been eliminated after this revision in 2019. Now, few basic conditions for computing the eligibility of this scheme. The NFE of USD must have been 15,000 USD in the preceding financial year. In the 2015, when the scheme was introduced, it was necessary to see if in the year 2014-15, one has provided the services worth 15,000 USD or not. If the answer was yes, then he could have claimed the benefit right from day one. And the same system kept on following. If somebody has begun claiming the benefit in the year 1920, he had to see if he had reached the benchmark in 1819 or not. If the answer is yes, then he could claim the benefit in 1920. This is the threshold limit. Then services provided in below two modes are eligible to take benefits of SCIS. One, supply of a service from India to any other country, which is a cross-border trade. And mode two, it's supply of services from India to service consumers of any other country in India. So both the options are available. The third condition too is service provider should export only notified services. So if a service is not notified, the SCIS benefit is not available to that person. Now, these are the broad 8 categories of which are notified services. accounting, auditing, and bookkeeping services, research and development services, technical testing and analysis services, advertising services, engineering services, cargo handling services, health related services, transport services. Now on the right column, the 2 number cargo handling services is the service category that I was referring to, in which DRI has initiated its investigations, identifying whether a particular service is really categorized as a cargo handling services or not. So that is why it becomes important to identify the category of your service and then initiate your application for claiming this benefit. Moving on to ineligible remittances for SES benefit includes. So there are certain kind of remittances, although which may have been received in foreign exchange, are still not eligible for claiming SEIs. First one is foreign exchange remittances other than those earned for rendering of notified services. So if anything that is not notified and has been exported, then despite the fact that the remittances have been received in foreign exchange, the benefit is not available. The second category is foreign exchange remittances relating to financial services sector, like foreign currency loans, ADR, GDR, foreign currency bonds, etc. Contract regular employment abroad, like equity participation donations, export turnovers of EOU, STPI, BTP schemes. That is because the very mandate of these entities is to make exports. And then export of goods. Export of goods is eliminated because they have a separate scheme called MEIS, or now they have a separate scheme called ROTEP for that particular purpose. And that's why these kind of remittances are kept out of the SES scheme's scope. There are certain SES benefits which are not extended to STPI EOU units. The same logic, like I said, their basic mandate is to make the exports. Then key services which are not covered, very, very important, because the India actually has a very commendable presence in these export categories across the globe, which is information technology, banking and financial services, telecom services, services of a commission agent. These are all taken care by many of the Indian entities in India in the form of a KPO or process outsourcing category. And despite that, these service offerings are kept outside the SES scope and are not given the benefit. Moving on, the duty credit script. The benefit of SEIS is again given in the form of duty credit script. We saw the snapshots of, or rather the ideas of how script functions while discussing ROTEP itself. Quickly recapturing, duty credit script at notified rates on NFE, net foreign exchange multiplied by the rate allotted to a particular service category is how one computes the entitlement. The benefit is then given in the form of duty credit scripts. These scripts can be utilized towards payment of basic customs duties, composition fees, various application fees under the FTPs, so on and so forth. And if those avenues are not available for an exporter, then he could also transfer these scripts because they're transferable. They can sell this out at a discounted price to intended buyer. So that is a utilization mechanism for this duty credit script. Now, the limitation periods for this script is also important. In fact, sitting in the year 21, it is really important to take a look at these numbers because the scheme is now at this particular point in time available only till 31st March of 2020. And therefore we are already ahead of the basic limitation period of 12 months. One was expected to file an application within 12 months from the relevant financial year to claim this benefit. Now that period has already lapsed. So what happens? In a very basic manner, if I have to say, there is a late cut that is applicable, pegged at 6 months, 12 months, and beyond 12 months between 2 years. There is a cut between the total entitlement value to the extent of 2% and 5% or 10% respectively if there is a delay in the application. Also, because of certain lockdown mechanisms and the notifications relaxing the limitation periods, the lockdown tenure has been eliminated out of this limitation period. And at this point in time, as we speak today, one can claim the benefit for the year 1819 with a late cut of 10%, and the benefit of 1920 can be claimed without any late cut. So that is how the benefit will be computed. So anybody who is engaged into export of service and is somebody who can compute their entitlement, and it is just right time, and in fact it is it is somewhere, we are about to lapse that period as well. And one has to rush a little bit to find out what their entitlement is out of these schemes. Now,
Ketan, if I may add a few points on SCIS.
Sure.
So noteworthy is that, as Ketan said, if there's any SCIS of 1819 and 1920, then it has to be dealt with ASAP, and 31st December 2021 is the threshold. That's number one. Number two, while, erstwhile there was a larger entry of management consultancy services as well, on which this benefit was available, for the year 1920 in particular, this particular line item of management consultancy services has been taken off the book. That is to say, the scope of this entry people used to take as very wide, and everything and anything under the sun they would categorize as management consulting, and therefore, it was a burden for government. They felt that, as at least 70 to 80% claim of SCIS are being filed under this entry, and therefore they have omitted that entry. Number two. Number three, so far as entitlement benefit is concerned, up till 1819, if I am a Tata entity and I have, millions of exports, I could have claimed SCIS even up to 50 crore of rupees. I could have obtained a scrip, the total of which is 50 crores. But for 1920, the government has come with a curtailment which says that I cannot get a benefit of SCIS of more than 5 crore rupees so far as SCIS is concerned. So these are 3-4 important categories. Also noteworthy, it is from a practicing CS perspective. Whosoever are your clients, whether they are exporters of goods and exporters of services, always ensure that they have an IEC in place, Importer-Exporter Code, and also RCMC certificate, registration cum membership certificate of some association. Unless these two documents are there, these benefits cannot be claimed from the DGFT. So, आज आपका player, आपका client export कर रहा है या नहीं कर रहा, लेके रख लो, future में तो करेगा. So, at any point in time, all of your clients must have IEC as well as RCMC. Very, very critical for all of our friends who are practicing. Yeah. Thank you. Thanks, Ketan. Please carry on.
Yes. So now with this, we actually come to an end of the post-exportation schemes and, move on to pre-import schemes. Now, we saw that, there is a scheme called Export Promotion Capital Goods Scheme, which is meant for import of capital goods, which could be used for manufacturing export products. I would request Rajat to, explain the briefs of EPCG.
So
scheme.
I did previously as well. So we did discuss that, I have two ways to import capital goods. As a advisor, as an industry person, you have to see whether are we doing any expansion in capex. If yes, there's always ways and means in order to optimize them. Yeah. So if I am importing capital goods, one, I can pay the entire duty at the rate of 30%, or second, I can import these capital goods under EPCG, and a corresponding obligation I take up from Government of India. As I said, multiplier of 6, which will be explained in greater detail. Not only this, as CapEx, this is one benefit available under FTP. At the same time, from a CapEx standpoint, there are industrial benefits available as well. If I were to speak in the context of Maharashtra, there's a specified scheme called Package Scheme of Incentives 2019. So when we are talking about CapEx, lot of application, lot of deliberation has to be done as to how can, as an organization, as a practicing CA who is helping some entity, we can optimize these costs, not only of the taxes and duties, but how we can get extra incentives also from the local government, state government under the industrial policy. Yeah. So, Ketan, over to you to take us through the nuances. Thanks.
Right. So, quickly taking through the import of goods by EPCG holder. EPCG scheme permits exporters to import capital goods without any import duty. IGST and compensation cess exemption for the purpose of EPCG is valid only till 31st March 2022. Initially, this exemption was not in place, but because there was a lot of cash flow issues that happened in 2017 when GST rolled in, the industry really demanded for certain relaxation. Relaxation was given up to 31st of March 2018, and since then it is getting extended until now, and now it is extended at this point till 31st March 2022. Then domestic procurement by EPCG holder is also permitted. Supply of domestically manufactured goods to EPCG authorization holder qualifies as a deemed exporter under GST laws. So somebody who is procuring under domestically as an EPCG holder, then the supplier gets the benefit of deemed exports. Either EPCG holder or DTA supplier can claim refund of GST paid on such supplies qualified as deemed exports. So that is the hidden benefit out of this domestic procurement. Then actual user condition. The EPCG holder has to use the capital goods on his own account until he has completed his export obligation. So that is the meaning of actual user condition. He does not have the option of selling this machinery or handing it over to somebody else. If he does so, then he has to recoup all the customs benefit that he availed as an exemption benefit along with interest, and then only he gets to surrender the benefit of EPCG and then hand over the machinery. Then nexus certification. A nexus certificate from an independent chartered engineer is required to be submitted while filing the application. Reasonable wastage at the time of installation of goods needs to be defined. All the above conditions would form a part of condition sheet of the EPCG authorization at the time of issue. Meaning what? That one has to ensure that the goods being imported, that the capital goods being imported has a direct nexus with the manufacturing process of the goods which is being exported, and that needs to be documented. This is for the purpose of verifying the status of EPCG license at the time of evaluating whether one has completed its export obligation or not. Again, certificate of installation of capital goods is the next step of nexus certification. Once you have proven that this is what is the necessity is, it also needs to be certified by a chartered engineer that the goods have actually been installed for the purpose which was depicted in the nexus certification. जैसे बोला था वैसे material actually install हो चुका है. That is the very limited purpose of this particular certification. There is also a time limit given for installation. The machinery must be installed within a period of 6 months from the importation. Of course, there are relaxations given into it. It is not hard and fast that, if machinery is imported, at times the machinery is really, really large, and adhering to these timelines becomes tedious, and therefore authorities have the discretion to allow you the extension of 12 months and 3 years subsequently. Now, there are some other tenets of the procedural aspects out of the EPCG. EPCG authorization shall be issued with a single port of registration for imports. However, exports can be made from any port specified in paragraph 4.37 of HBP. So the machinery can be imported from a particular port that you could declare in an application for EPCG. And the finished goods manufactured out of that particular machinery can be exported out of any other port. That is what point number 1 is. 2, validity is the license remains valid for 18 months from the date of issuance of authorization, meaning that you have to import the machinery within 18 months from the authorization. And a revalidation of EPCG is not permitted. So once this 18 months period has lapsed, you cannot revalidate this EPCG. You have to apply afresh for another EPCG license for the same importation. The last point says realization of export proceeds. Export proceeds shall be realized in freely convertible currency. Everywhere we see realization of export proceed, it means that the condition of export proceeds is annexed with this scheme. This is aimed only at the fact that the purpose of foreign trade policy is achieved, that foreign currency is brought into the country. So that is the purpose of condition number 3. Export obligations, a little bit about export obligation. Import under EPCG scheme shall be subject to a specific export obligation equivalent to 6 times. We saw that earlier, Rajat explained us nicely. In case of indigenous outsourcing of capital goods, specific export obligation shall be 25% less than the stipulated EO. So typically the export obligation is a 6 times multiplier, minus 25 if the machinery is being procured domestically. That is how this export obligation is calculated. And while fulfilling this export obligation, one has to ensure that average level of export is computed first, and an export made in surplus of average level is only taken in consideration for computing your export obligation. Now, average level exports, simply put, is you consider your previous 3 years exports, bring out an average out of it. That is an average export that you were making before importing the machinery under EPCG. Now you have imported your capital goods out of the EPCG scheme, which means your export should increase in a corresponding manner, and that surplus exports alone will suffice your export obligation. That is the simple calculation. Now, block-wise fulfillment of export obligation. First block of 4 years allows you to fulfill, or rather it requires you to fulfill 50% of your export obligation, and balance 50 year can be fulfilled in the 5th and the 6th year. There also, although extension is available in these export obligation periods, you have to make an application based on a fee that needs to be paid at a particular percentage of your balance export obligation. And this export obligation period, as the FTP has the provisions of extending these export obligation periods. Now, moving on to some other aspects of APCG. The obligation is monitored on an annual basis. Every year, the exporter has to furnish a report stating how much export he has made, out of which export obligation, the average levels are to be also explained, and the surplus export is also to be provided in that report. It's kind of a return that needs to be submitted on an annual basis. Then clubbing of EPCG authorizations. Clubbing of 2 or more EPCG authorizations issued to the same authorization holder would be permitted. Clubbing shall only be permitted in case export products endorsed on the authorizations are same or similar, and if authorizations are issued by the same regional authority. So 2 important conditions for clubbing. 1, the authorization must be for the same kind of export product, and the authorization must have been issued by the same regional authority. That's when you have an option of clubbing these export APCG authorizations. Total export obligation would be refixed taking into account total duty saved amount of the clubbed authorizations. So authorization number 1 has a XYZ amount of duty saved. Authorization number 2 has a PQR amount of duty saved. Both will be added together, and then a multiplier of 6 will be added to decide your export obligation. Of course, less the exports that are already made out of the existing EPCG authorizations in these. Then redemption part is authorization holder has to make an application in form ANF 5B with documents prescribed therein as a proof of export obligation fulfillment. And on being satisfied, all these documents are being changed by the RAs, and the RA concerned then will issue a certificate of discharge of export obligation. We call it typically OECD, EODC, export obligation discharge certificate, to the EPCG authorization holder and forward a copy to the customs authorization, with whom a letter of undertaking or a bank guarantee has been executed by the exporter. Maintenance of records. For a period of 2 years from date of redemption, a true and proper account of exports, supplies made and services rendered towards fulfillment of export obligation is required to be maintained by an EPCG authorization holder. Now, with this, we come to the second scheme, which is a pre-import scheme called as advance authorization. The primary difference between EPCG scheme and advance authorization is that EPCG is meant for capital goods and advance authorization is meant for raw material or packing material. The objective or the entitlement, quickly going through, is advance authorization scheme enables exporter to import raw materials. We saw that part. Eligibility is manufacturer or merchant exporter tied to a supporting manufacturer exporter. Exporters having post-export performances. Entitlement in terms of CIF value of imports shall be up to 300% of the FOB value of physical exports and or FOR value of deemed export in preceding financial year, or rupees 1 crore, whichever is higher. So that is how your entitlement is computed. Period of validity for imports is once the authorization is issued, you get 12 months to import the raw material for which authorization is issued. Then one of the key conditions is that the issued inputs in relation to resultant product as per standard input-output norms. Rajat had already explained this aspect. Both advance authorization license and materials imported thereunder shall be subject to actual user condition. We saw the actual user condition in EPCG. Exactly the same concept is borrowed in advance authorization as well. Exports with a minimum value addition of 50%. There's a condition that one has to make 15% of value addition in the finished goods before being exported. And export obligation shall be fulfilled within a period of 18 months from the date of issue of authorization. These are some of the important conditions. Now, we have already seen this particular aspect. AA scheme exempts customs duty and IGST on import of inputs which are used in export products up to 31st March 22. domestic procurement by AA holder is also allowed. Just the fashion in which the benefit of APCG is also given for domestic procurement. Benefit of advance authorization is also provided for domestic procurement, in which either an advance authorization holder or the domestic supplier can claim the refund of GST paid on such supplies. Then validity of advance authorization, we saw that to be of 12 months. Actual user condition, we saw that condition specifically. Annual requirement is also a category of advance authorization in which one can provide an annual data to the government authorities, to the DGFT authorities, stating that this is the requirement on an annual basis and get an authorization meant for all the imports. So this kind of an annual requirement has to be submitted on an annual basis, and your authorization gets on renewing on its own once you furnish this information. So you do not have to furnish or rather make an application afresh every time you have to get the benefit of, or rather claim the benefit of advance authorization. So that's one of the ideas of advance authorizations as an annual requirement. Now these are the computations of benefit. Current value addition needs to be computed at 15%. We saw that earlier. Then minimum value addition, again, export obligation is provided. Extension of EO period. Export obligation period is also, again, capable of being extended under advance authorization. Again, just in the same fashion as APCG provides for. Then monitoring export obligation, one has to furnish an annual, or one has to furnish, periodical reports stating how much exports have been made throughout the export obligation period. Then clubbing of authorizations is also possible. For the purpose of redemption, one has to file an application along with the proofs of exports that have been made out of the raw material procured under advance authorization. And all of these records have to be maintained by the advance authorization holder. So some of the restricted inputs, quickly taking a look at, all vegetable edible oils classified under Chapter 15, all types of cereals, horn, hoof, and any other organ of animal, wild animal, honey, all items with basic customs duty of 30% or more, all types of fruits, nuts, vegetables, second-hand goods. All of these are restricted under advance authorization scheme. These cannot be imported in India. Now, this was the pre-import benefits, APCG and advance authorization. Moving on to a very interesting aspect of free or preferential trade agreements, I'd request Rajat to spend some time over this and quickly explain this idea.
Thank you so much, Ketan, for a wonderful elaboration. So, up till now, what we have seen and understood are post-exportation benefits. We saw road tap, duty drawback. Thereafter, we saw SCIS. So far as, import side benefits are concerned, we saw APCG and thereafter advance authorization. Apart from that, there is another detailed agreements known as FTA, PTA. So these typically, are agreements either between two nations or more than, two jurisdictions, wherein they knit together and they say that, we will cooperate with each other. We will give preference to each other. So there's a better facilitation and a smooth facilitation of importation of goods, services, and resources. And this importation also happens at a reduced tariff rate. Apart from this, these agreements also contain, whether there can be any non-tariff barriers which can be imposed by one country or to the other, and to what extent. So this typically, forms part of an FTA, PTA. Yeah. So on to the next slide, we'll show you what kind of FTA and PTAs are there. Yes, please. Ketan, could we move to the next slide, please?
Is this visible?
Yes, please. It is. Yeah. So nature and categories of trade agreements, unilateral agreements, there, it is only one-sided. So within one country's foreign trade policy, they may curb, exporting or importing from a particular nation. They may, have an restriction qua exporting or importing a particular product. In the, pandemic stage, we saw so many products were, restricted to be exported. For example, PPE kits, etc., etc. We were foreseeing, from a foreign trade policy perspective, whether these goods in the country are good enough to cater to the domestic need. And if we have excess, we were allowing to export. So this is something you can say is unilateral kind of an agreement. Bilateral is, as I said, when it is between two countries. Multilateral, when you have something like ASEAN, SAFTA, if any of you have heard these names, wherein, either the SAARC nations or the Southeast countries, they pull together and, sign this one comprehensive agreement. So you have, from an integration, economic integration perspective, some of them are known as PTAs, FTAs, SEPA, and Custom Economic Union. So depending upon whether we are talking about integrated packages, goods, services, IPR, then you can say it is a SEPA. If it is only between substantial bilateral trade between countries, for example, Indo-Sri Lanka kind of a thing, it is an FTA. And if, the idea is only to reduce the tariff rate on specified items, then, it may be termed as a preferential trade agreement. Yeah. Yes, please, Ketan. And these are some of the species of, existing agreements we have, with the rest of the world: SAFTA, SAPTA, ASEAN. These are all, multilateral agreements. And as we speak, there are some agreements which are, on discussion stage with Australia, with UK, and with other, developed nations. We are sitting with them. Our, Ministry of Commerce teams is sitting with them, and they are negotiating certain agreements with them as we speak. So these are some of the examples where, India is involved today. So far as, the benefits is concerned, typically one benefit under PTA, FTA is that, if I'm importing certain goods from a specified nation wherein we are signatory. So it may so happen that if I'm importing, say, certain motherboards falling under, say, Chapter 49 from China, it may attract a BCD at the rate of 10%. Whereas the same product, if I'm exporting under another agreement, SAFTA, from any country which is signatory to that agreement, it may attract a BCD rate of 0%, 2%, or even 5%, depending upon, how the rates have been scheduled in these retail agreements. So as I said, in all these agreements, whether it's an integrated larger package or only non-tariff barrier, the idea typically is that two countries or many jurisdictions should come together and they should facilitate trade. And in that sense, importing from their countries and paying lesser duty is essentially part of these agreements. That reciprocal commitment from both the countries are definitely there. While there is a benefit on one hand, there has to be a corresponding obligation on the other. This is how life works. And in that context becomes relevant is rules of origin. So if, say, I am, facilitating one agreement with Japan, and I am saying if rules of origin, rules suggest that, it has indeed come from Japan. Now, rules of origins are defined for these agreements that 40% or 50% value addition ought to have been done in that country with which we have the agreement in order to get the benefit of a lower duty rate. So that has to be demonstrated with the help of documentation, etc. It may not so happen that from China, the goods have gone to Malaysia, and from Malaysia now they are coming to India as, satisfying the rules of origin from Malaysia. This kind of distortion should not be there. And this is the precise reason that of late, many strict rules, have been introduced for applications of rules of origin, wherein additional powers have been given to, assessing officers in India, custom officer, that, apart from these certificates or documentation of rules of origin, they can do a further deep dive in order to understand the true reality and substance of the transaction and where these goods were ultimately imported. So rules of origin, are used for implementation of commercial terms to determine, most favored nation treatment. These are used for the purpose of trade statistics, for government procurement purposes, and so many other things. But typically, rules of origin certificate, they symbolize that with whosoever country we have signed the agreement, the goods are indeed coming from that country, and the rules specified in that regard for the value addition are truly and fully satisfied by the exporter country. If those rules are not satisfied, the benefit under that SAFTA or any other agreement is not, accorded to by the customs officer, and therefore you don't get a beneficial rate under the customs notification. Yeah. So it's a very, very, critical condition. Overall benefits, which happens, which take place from an importer and exporter perspective is number one, we have been discussing this reduction in tariff concession. Number two, there are other commercial advantages also in terms of non-tariff barriers, etc., to exporter and importers. There are strategic investments. If we are talking about comprehensive agreements between the countries, there is not only, facilitation for investments and also, facilitation qua IPR is provided, in such contracts as well, very comprehensively. And non-tariff barriers, again, these days, instruments like BIS, Bureau of Indian Standards, etc., are being implemented by Government of India on many of the products, especially, which are coming from China. So if any country gets an advantage of non-tariff barriers from India, there, we are giving them the commitment. If the goods are coming from your side, we will be imposing non-tariff barriers to the minimum, in terms of some of the restriction and terms and conditions which would have been forming part of the overall agreement. So these are typically the, benefits that accrue to importers and exporters while, they take benefit of FTAs and PTAs. Yeah. On a going forward basis, see, for somebody, who is not analyzing FTA and PTAs, these are detailed agreements, and thereafter, a detailed schedule in which you have to scan through your HSN code, you have to adhere to the rules of origin guidelines, etc., etc., in order to take a particular import benefit. One, this is a very, very interesting subject and something, which we should embrace in terms of getting, more benefit to our clients. One, as a deliverable. Number two, if say India already has an agreement with Malaysia and you feel that some of your products or your clients' products are not featuring therein, you can very well go to Ministry of Finance, DGFT, MOF, and file a representation that while so many other products of similar nature are getting benefit under FTA, this particular FTA, PTA, why not ours? And these are the rationale why, our product should also be added to that. Time to time, these existing agreements, are revised, and, these officials from different countries, they sit together and they negotiate, what are the pluses and minuses and how these existing agreements should be modified in order to benefit the industry on both sides of the countries. There are trade compliances, of course, the thorough documentation and all the linkages one has to support, with to the satisfaction of the officer while we enjoy all these benefits under FTAs and PTAs. And as I did say, government advocacy can be done if some of the products are not covered. Real efforts can be put on ground level, and some kind of facilitation, may be brought to your clients who are not getting benefited from FTAs and PTAs as we speak. Yeah. So, with this, we conclude today's presentation. Once again, we thank ICAI and Committee of MSME and Startups. We are grateful for this opportunity. We believe that our CF friends and colleagues would have got benefited from this discussion. If, on a practice level or on an implementation level, you have any specific question, you may, write to us, Ketan and I, and we will be very happy to, support and guide to the fullest of our ability. And now I hand it over to the technical support team for any Q&A if we have any questions. If are there asked by the August audience, we are happy to take those up.
Certain questions we have. What are the incentive schemes available for the startup venture working on sustainable projects?
So, so far as startup for sustainable thing is concerned, developments are concerned, of course, there are certain income tax benefits available for sure. Yeah. Apart from that, I don't, recall any other particular benefit available. If certain specific facts could be shared with us, we could do a deep dive and share with us. And, we'll be happy to come up with our findings. But for startups, of course, there are income tax benefits which are available, so that we can, help the particular member to address specifically if he wishes to reach out to us.
What are the avenues for MSME segment for accessing the capital and debt market? The industry is suffering a lot for want of working capital needs. majority of NPA cases are on account of working capital shortages, despite good business models and viability.
So, of course, from an MSME perspective, what we have covered today primarily is on account of taxes and duties, the benefits, that MSME can embrace. So far as the loan schemes and other things are concerned, I think last year, the government of India had indeed, expanded the definition of MSME. And also there were certain schemes specifically pronounced under the COVID, wherein, certain loans can be given to MSME categories who are registered with under the MSME Act and so on and so forth. So again, we have a separate practice partner for this. I'll be happy to connect my practice partner who takes care of this with the relevant person, and we'll be happy to take it up accordingly.
Interest subvention to exporters is extended or not?
So there are talks of interest subvention scheme. The government was mulling over it, but as we speak, that decision is yet to be taken. But still, that is under contemplation. And if we, once we have the final blueprints of fine print of this new FTP effective April 1 of 2022, we may see that, some extensions have been made in that regard as well.
I see the eligibility list for SEIS. Information technology services is not covered. Just to reconfirm whether it is covered in the SEIS or not.
So typically, IT sector, ITS we're talking about in the question. So typically, you have either set up an STPI or SCZ for providing such services. And as Ketan very categorically said that, it is the mandate of STPI, your software technology park units, and also the SCZ units. So the government did not, extend this particular SCIS benefit to them because they were already getting so many duty benefits. Under STPI, you have 52 by 2003, 22 by 2003 in the past of excise and custom, they were getting benefit. Now similar benefits are there under GST as well, barring the GST itself. And similarly, in SCZs also, we have so many duty benefits. So this particular benefit has therefore not been extended to SCI as per the mandate.
Each SEIS scheme available for data analytics companies, which are often wrongly categorized as IT companies?
I would think yes. So there are, CPC codes. So these are broad categories we had discussed. If you go on the DGFT portal, there's a particular notification which was issued a couple of months back, which talks not only, talks about the service name, it gives you the CPC code. And then, there's a national schematic data. You can go and do a deep dive into this CPC code. For example, we are talking about repair and maintenance services. There'll be 10 subheads and clear definitions. So if we do a deep dive into that, I would imagine prima facie, data analytics should be one of the, eligible category, but subject to doing a deep dive into that.
What about the multilateral trading system in India and other developing countries, which can be, that one is opportunity for the MSME?
So a lot of agreements are there, we'll be happy to share this presentation through Sambitji to our august audience. So there are so many benefits as we spoke about multilateral agreements, under SAFTA, under AFTA. So whatever, importation is happening, you have to analyze what is the HSN code from an importation perspective. And if, your products are falling under those HSN code, you have to take care of the rules of origin condition and the certification and the support documentation. If we adhere to all these, norms and documentation which are required to, we can, suitably take the advantage of these agreements.
Okay. What about the most favored nation status, and what about the opportunity in that most favored nation?
So this particular phenomena, deals with a scenario that, if I have given a most favored nation, category to somebody, and they are, they are getting a, advantage over PCD rate. So no other benefit, no similar benefit or a reduced agreement rate I cannot enter into with any other country, or even if I have the MFN country to which I have given the status, the same reduced rate gets, attracted to that country as well. So that's the concept. And yes, once, any agreement later, I don't, recall any agreement where this may be invoked. But in future, we may have certain, such cases where, because we are already negotiating some of the contracts, some of the agreements with the larger developed nations. So this usage of MFN may come handy, an advantage may be, taken of that later on.
Is there any benefit derived from the export-import policy?
Absolutely. So I can very categorically say in the COVID scenario, in Pune market, Mumbai, Delhi, so many guys who were not aware of these benefits, we approached to them and, we got them benefits they were never aware of. They did not know that anything like SCIS exists under the FTP or, such a scheme is rolled out by Government of India. So indeed, such schemes yield benefit. You apply FIRC and other documentation prescribed, you file. The strip does come, with the suitable licensing the authorities, and thereafter either you use them yourself or they are sold in the open market. I have helped clients in the COVID time and, got 50 lakh rupees, 80 lakh rupees into their account. They have come to our office and they have hugged us. You have got us a benefit we never knew. So yes, these benefits indeed exist. They are not only existing on paper, they actually exist on ground level, and these schemes do work.
Good evening, everyone. We'd like to thank our speaker, CA Rajat Chhabra and Advocate Ketan, for enlightening us with the various facets of import and exports and its benefits. Today's session gave us deep insights into the topic and also revealed some interesting facts. Once again, we'd like to thank CA Rajat and Advocate Ketan for taking out time from their busy schedule and enlightening us with their knowledge. Thank you so much, sir. Also, we'd like to thank to all participants present here for paying their attention and learning. With this, we conclude this virtual CPE meeting. Thank you to all.
Dr. Sambit, we are grateful for the opportunity. Thank you so much to all.
Likewise. Thank you so much, sir.
Recording stopped.